Hello and welcome to Options in Plain English Advanced Edition. This series is going to be intended for traders who have been trading for a while and that have a good grasp of the basics of option trading. So today we're going to be talking about volatility skew and its impact on spreads and naked options. Many people don't know, or many traders don't know, that when you're trading, sometimes you refer to something as being expensive or being cheap. And when we talk about naked options and spreads, sometimes we compare and contrast the two of them, and we have a good understanding of which ones are cheap and which ones are expensive so that we could try and buy the cheap ones and sell the expensive ones in order to try to get the best edge that we can when we trade options. To illustrate this, we're going to be taking a look at a stock that is Nike in this case. Nike is trading at $85. So the ticker symbol for Nike is NKE, and it's trading at $85. So that we know that the options that are at 85 are the at the money. The puts that are lower at lower strikes are going to be the out of the money, and the calls that are higher than 85 are going to be the out of the money as well. So we'll be analyzing the expiration for May 2020, 30 days to go. And first thing we can notice here is that we have all the implied volatilities per strike. As you know, every option has an implied volatility based on its price because it's the only unknown if we apply an option pricing model such as Black-Scholes. So we have different implied volatilities for different strikes, and if we analyze the out of the money, in this case we're going to focus because those are the ones that have the most liquidity. We're going to analyze the out of the money calls and out of the money puts and their implied volatility based on strike. If we plot them in a graph, we'll get what we call a volatility skew graph. So basically, the not every strike has the same volatility, and this is called the skew. And we'll take a look at how Nike or Nike's options have different implied volatilities based on strike. So here we took all the volatility. So here we're plotting implied volatility versus strike price, and we're focusing only on the out of the money options. As you know, the implied volatility is a measure of how expensive or cheap an option is because the level of implied volatility is directly related to the price of the option. So an option that has a certain implied volatility, if the implied volatility were to be a little bit higher or lower, the price will change based on that. If it's higher, the price is going to be more expensive, and if it's lower, the price is going to be cheaper. In this case, we're analyzing the same underlying, same month. So the only thing that's changing is the strike price. And we can see that for the same underlying, the implied volatilities here are very different. In this case, for example, on the downside, the low strike prices have higher volatility as they go lower, and the higher strike prices start going lower and lower until it flattens out at a certain point here. So this is a usual when you analyze different types of products. This is a very usual structure when talking about implied volatility. This is what's called reverse skew, also called a smirk, because it's not a smile, it's not symmetrical. Some products show a very symmetrical configuration here in terms of implied volatilities versus strikes. But usually equity products display in their options something called a reverse skew or a smirk, meaning that it's high on the low strike prices and it's low on the higher strike prices. Keep in mind, this is the same underlying, same month. So the only thing that's changing is the strike price. So this is why when we analyze this, there are certain strategies that could, in a way, try to take advantage of this. Now, keep in mind, we're not discovering anything new or anything that no one knows. Everybody knows about this, so it's important that you also know about this. Okay, so basically the skew exists because the market is trying to anticipate that, for example, Nike is trading at $85 right now, but if Nike was trading at $75, since volatility moves inversely when compared to the underlying price, as an equity starts falling in price, the volatility is going to go up. So it's basically trying to anticipate the future in a way, saying that, okay, if we ever go to 70 and 70 becomes the new at the money, then we're going to be at a higher level of implied volatility. And that's actually what happens. So it's not so much that it's a flaw in the market, although the Black-Scholes model, the way the pricing model assumes that there is a flat skew or there is no skew. So this is, in a way, a pattern that markets display because they're anticipating what's going to happen if the market ever gets there. So we have the skew, we have the at the money, which is $85 here. And we're going to start analyzing. And to analyze what is expensive and what is cheap, we're going to have a comparison between puts, so naked puts, put spreads, call spreads, and naked calls. So we're going to figure out whether a put is cheap, a put spread is cheap, a call spread is expensive, naked call is expensive, and that way we can think of strategies that may take advantage of this. So to start with, we're going to be looking at the calls on the higher portion, so any strike price that's higher than the at the money, and the puts on the lower portion, so any strike price that's lower than the at the money. So in the case of calls, we're going to simulate a call spread, buying a call spread. So in order to know whether that's expensive or cheap, okay. So in order to buy a call spread, as you know, we need to buy the first strike and then sell the further out of the money strike. So this is what's called buying a call spread. And now when we analyze whether this is expensive or cheap, we can see that we're buying something that's expensive. Remember, implied volatility is directly related to price. So we're buying an overpriced option, so to speak. We're buying an overpriced call and we're selling a cheaper call. Remember, it's not that the price is cheaper, it's the implied volatility that's cheaper. So not only is it going to be cheaper in price, obviously, because it's out of the money, but relatively, even considering that, this option is going to be cheaper because of the skew of the implied volatility across the different strikes. So because of this, when we buy a call spread, we can say that a call spread is expensive because we're buying something that's expensive and we're not getting too much back in the form of the one we sell. So we can say that the call spread is expensive. Now, what about the put? What about the put spread? The put spread, we buy a strike and then we sell a further out of the money strike. So it would be a lower priced put. So we can see here, we're buying a level of implied volatility, which is related to the price, and then we're selling something that's more expensive. So we're buying something cheap, we're selling something expensive. We are spending a little bit of money and we're getting back more money. Of course, the price is not going to be higher, but the relative price is. So accounting for the different strike price, so the fact that this one is further out of the money than this one, we can see that the put spread is going to be priced, since we're buying something cheap and selling something expensive, the whole spread is considered to be cheap. Okay, so we figure out so far in terms of spreads that the put spread is cheap because we buy something cheap, we sell something expensive, and that the call spread is expensive because we buy something expensive and we sell something cheap, based on the implied volatility curve, but based on the implied volatility skew graph that we have. And this is actually real data that I just took from the market a minute ago. So this is the way it works for equity products. Okay, now if we talk about, for example, commodities, they may display a different pattern of skew. So these conclusions are not going to apply to those. It only applies to skew patterns that follow these rough estimates or these rough characteristics. Now, we haven't determined whether the naked put and the naked call are cheap or expensive, but we can take a look here. Now we're going to compare the naked put and the naked call. So we're buying this one here at this level, this call, and then we're buying this put at this level. They're equidistant. They're supposed to be priced the same, but they're going to be priced differently because the put has a higher implied volatility than the call, because IV tends to go higher for equities as price goes lower. So we can say that the naked call is actually cheap compared to the naked put. So the relative value is going to be the call is cheap and the put is expensive. Okay, so now we have our little table here that most traders, when you've been trading for a while, this becomes second nature. You know that put spreads are cheap, so you try not to sell them, and call spreads are expensive, so you try to sell them. So you try to buy put spreads, you try to sell. But so basically what you want to do as a trader is to gain that little bit of edge, and any edge is welcome when you're trading options and when you're trading anything. So you try to get the edge by buying cheap options and then selling expensive options and spreads. So when we know this, we should try to sell the naked put, buy a put spread, and then the other way around for calls. Sell the call spread and buy the naked call. So the put's expensive, the call is cheap. But the spreads are the other way around. The put spread is cheap because of this, because of the one we sell at a high price, and the call spread is expensive because of the one we sell at a lower price. So we should try to sell call spreads, buy put spreads, sell naked puts, and buy naked calls. Not only should we try to do this, but when we talk about combinations, we're also going to find some strategies that take advantage of this. And sometimes maybe you've already used them, but you don't know why they exist. Well, the reason they exist is because of this. So we're going to take a look at some strategies, some real data, some real takeaways that you can use later on, so that you know that these strategies take advantage of skew if the skew for that product is something similar to this, basically a typical equity IV skew. Let's start taking a look at some of the strategies that take advantage of skew in order to try to get a little bit of edge based on skew. The first one we're going to take a look at, it is somewhat simple and straightforward. We're going to have our cheat sheet right here. So it's a put ratio spread. So what's a put ratio spread doing? You're buying, remember how to read this risk profile graphs. The puts are going to be with a P, It's a little circle with a P. And then the calls are going to be with a C, obviously. And the ones that are on top of the underlying line are the ones we're buying. And the ones that are on the bottom or under the line are going to be the ones we're selling. So with a put ratio spread, we have the at the money price. This is the price that the underlying is trading at. So you buy a put spread. So basically you buy this one and you sell this one. So this is a put spread. I'm buying a put spread. So I'm buying something cheap. And I'm also, on top of that, selling another put to partially pay for this. So I'm buying a put spread cheap, and then I'm selling a naked put expensive. So I'm buying something cheap, I'm selling something expensive. I put them together, and this is going to be an efficient trade. Doesn't mean that it's going to be a winner for sure, but you are taking advantage of the fact that the IV here is going to be lower than the IV here. So you're basically buying cheap IV and then selling expensive IV. So you try to take advantage of as much as you can. So this is a put ratio spread. So basically, if for example, in our example, if Nike was trading at 85, we could buy the for example, we could buy the 80 and sell 2 of the 75s. And at that point, we're probably going to do it for a credit. So anything that goes above, if it expires above this price or in this area, it's going to be a profit of this, and then starts going higher, and until this point is a break even. So the loss, this red portion, is going to be somewhat smaller area, because we're taking advantage of this, and then we're pushing the break even point a little bit further down. So it's a put ratio spread. A lot of traders use them. I use them all the time. And this one, one of the things I could say about that is that it should be initiated for a credit, or even in worst case scenario, and you're going to be margined on the naked put that you're selling. So the margin is going to be as if you were shorting a put. Okay. Another trade that we can take a look here is called the Jade Lizard. The Jade Lizard is something that's similar to an iron condor. As you can see here, we're selling this call spread, and instead of selling a put spread, we're simply not buying the put on this side. Okay, so we're selling a call, buying this call, selling this put, but we're not buying anything. So what we're doing here is basically selling a call spread, and a call spread is expensive, and then selling a put, which is also expensive. So we're taking advantage on both sides. We're selling a put, and then we're selling a call. All of them are expensive. We should be getting a good credit that would offset the movement of the price in this area. Now, again, it doesn't mean that it's going to be a winner necessarily, but it means that we're taking advantage of the skew that is presented to us in equity products. The condition here, for example, to get no risk to the upside, it would have to be that the credit that we get from the put plus the call minus the call that we bought has to be greater than the width of this spread. So basically, this plus this minus this should be more than this width, so that if we start losing, if it starts going higher and it goes further than we thought and further than we expected, we're still not going to lose money, because the total credit is going to be covering the width of this spread. So for example, to do an example with Nike, if Nike was trading at 85, we could sell the 80 put spread, for 80 put, sell the 80 put, and then sell the 90-95 call spread. And if the whole thing is done for over $5, then for example, we could if you can put it on for a credit of $6, then it doesn't matter that it wouldn't matter if you go beyond the call we bought, because you're just gonna lose this money, the money between the C1 and C2, but because it's more in the width, then you're not gonna lose anything. And that way, there is a huge area where you have some profit. Okay, this is the Jade Lizard, and now we're gonna take a look at another example. This is somewhat complicated, but don't be afraid of sinking your teeth into something that seems complex. It's really not. This is called the Delta Buster, and this is one of my favorite strategies. You'll see why. So basically, if something is trading at the money, which would be right here, and then you wanted to bet on the downside, you could, for example, buy a put spread here. So you'd be buying something that's cheap, and you're gonna pay for it by selling a call spread that's expensive. But check this out. So you should do it for 0 or a credit. So the condition should be initiated for even or for a credit. Okay? But check this out. So usually, if you do it right at the money and you buy the put spread and then pay for it by selling the call spread, you're gonna get a credit. So you can afford to push your call spread further until they equalize. So until what you're paying for the put spread equals what you're getting from the call spread that you're selling. Because this one's going to be more expensive, this is going to be at a strike price that's higher. And so what you end up with is a trade that you can put on for 0. So basically, I don't want to say a free trade because you're taking risk, but it's put on for no money. So basically, you buy the put, you sell the call spread, you gain this range here, where you still make money because you are, or where you don't lose money, rather. If you put it on for 0, then you don't lose money, and if you put it on for a little credit, then you're gonna make a little bit of money. And this is going to be something where you're betting on the downside, you're not putting money down, and your range, so your profitable range, is going to be wider than you would expect. When if you, for example, short the stock, which would be the equivalent, you would be shorting right here. The moment it goes higher, you'd be at a loss. In this case, the moment it goes higher, you're still making money because this call spread has not kicked in. So you're not losing money until you go over and you start getting beyond the short call here. Okay, so Delta Buster is a way to gain exposure to the downside, and while taking advantage of skew. And this is how we can take our knowledge and our expertise and put it to work in designing and coming up with strategies that take advantage of things like skew and how volatility behaves. So I hope that this was something that could be useful for you. This was an advanced lesson, so it's probably not for everybody. It's only for traders who've been trading for a while, but still, I hope that it was clear and that you can see and you can understand why us traders, why we use certain strategies and we favor something when compared to some other strategy. And as usual, we always try to get however much edge we can get on any trade. And this is a way to at least take advantage of the way the volatility skew is displayed or is shown in the market for most equity products. Again, this is only for equity products. So indices, ETFs, anything that has to do with equities. anything that has to do with commodities or those types of products are going to be displaying a very different skew. So probably it's not going to be a reverse skew, it's going to be a forward skew. As an example, gold most of the time displays a forward skew because the risk and the volatility is going to explode if it starts going higher, unlike an equity product. Same thing with commodities. If they start going higher, the risk is that they might explode in price. That's why the volatility is going to explode on the way up, as opposed to for equities, which have instability and become very volatile when they start going down. So hopefully that was something that was helpful for you guys, and I hope to see you around next time. Goodbye.